Okay, so we are in the live overtime session that sometimes follows our Tuesday community live stream. And what we do is get out a Zoom classroom, virtual classroom, and we go over first come, first served, whatever people would like to talk about in the chat. Erica was first into the chat saying that she wants to talk about internal rate of return, capital asset pricing model, Sharpe ratio, and total return. And I told her all of that is a waste of her time except total return. But, you know, you're the test taker. You're the one who has to decide whether or not you want to take my word for that and you want to devote the investment necessary for these issues when your time is better spent elsewhere. So now you know what you've been told, and you can do that accordingly based on what your decision is. Okay, so I'm knocking out the capital asset pricing model first. It's used to determine the required rate of return. So that alone could be a definitional test question. Which of the following is used to determine the required rate of return? Sometimes they use the word expected rate of return rather than required rate of return. The idea here is you have to be compensated for the time value. Now, the risk-free rate of return is also a test issue, and it's whatever you want to use to do the math. So be careful. Some of my friends are real estate professionals. They use a treasury note as their risk-free rate of return. Other people use T-bills. It doesn't matter. It's whatever you want to do the math. We're not going to be asking you about to do the math. You must be compensated for systematic risk, the risks in the system, the tendency of securities prices to move together. Now, beta is very testable. The most important thing about the capital asset pricing model is the concept of beta and the beta compared to the market return. This is very testable on all exams. So if I tell you the beta is 1.5, if I tell you the beta is 1.5 and the market did 10%, and I ask you on the test, what is the expected rate of return? You would simply take the 10%, you'd time it by 1.5, and you would tell me 15% would be your expectation. That is the risk reward trade-off based on that beta. So that is testable there. You know, beta is a measurement of the volatility as compared to the market. And a very simple calculation would be alpha. Alpha would be the excess of that. So in my example, I said the market was 10, the beta was 1.5. Our required rate or expected rate would be 15%. So we got 18 to 3% would be the alpha. That could be positive or negative. Again, you're not going to have to do this, but here's the formula. I've never had anybody ever tell me they've had to do this. So the risk-free rate of return is 4. Market rate is 12 and the beta is 0.8. So what is our expected rate of return on such an investment? So 4% is what we get for not risking our capital. So the point of the 4% risk-free is that's what you get for not hazarding your capital. So then we're going to take 12%. That was the market return minus 4, because remember 4 is what we could have got without risking our capital. We times it by the beta. And when we times that by the beta, we get 4% plus 6.4. And so the required rate of return would be 10.4 to make that investment. Again, I'm not going to ask you to do the math. I'm just going to ask you to recognize it. Now, Sharpe ratio, let's see, I don't know if I have Sharpe ratio on the slide, but Sharpe ratio is just how much reward we're getting for what risk we're taking. And what I mean by that is, maybe Erica gives me $1 million to manage and she gives Brian $1 million to manage. I'm just trying to find total return here for another one. I'll just do this one on the screen. But anyways, I say, Erica says, Dean, I've given you $1 million. I've given Brian $1 million. In 1 year's time, it's a beauty contest. Whoever has me the higher return, they get all my money to manage. And Brian and I accept that contest. And at the end of the year, both of us have made Erica $500,000. Both portfolios that we have created has $1.5 million. And so it looks like it's a tie. And Erica says, well, I don't know what to do given this situation. And I said, well, it's not actually a tie. She says, what do you mean it's not a tie? He's got $1.5 million. You've got $1.5 million. It's a tie. I said, no, my Sharpe ratio is higher. My Sharpe ratio is higher. The only test question is the higher the Sharpe ratio, the better. And what I'm telling you is I got you the same return as Brian, but I took less risk. So that's the Sharpe ratio. Internal rate of return is what takes a future value to the present value. 0, right? No net present value. The way they ask about internal rate of return, Erica, is if I buy a bond for like 900, I'm getting back 1,000. It has a coupon of 8, and my yield to maturity is 8.5%. That is the internal rate of return. That's what takes the 1,000 back to the 900. So if you get the internal rate of return, it's going to be asked as a bond question. And they'll say a bond's internal rate of return is most similar to, and you would say yield to maturity. Or they might say a bond's yield to maturity is most similar to which of the following, and you'd say internal rate of return. Total return is very testable. Total return is what you make from the investment's income stream and or price appreciation. So in that one, I think I have a slide for that. Let's see if I can find the slide for that. I think it should have been in the same one I just showed you, but for some reason I can't find it. Dollar cost averaging. Go strategies. If I don't find out, I'll just get a whiteboard. All right, just let me get a whiteboard here. So let's say on the test, I tell you that the stock. Can you guys see my whiteboard? Yes, no?
Yes, Dean.
Okay, so let's say a stock pays me $1 annual dividend. And let's say that I paid $20 for the stock. What's the technical name for paying $20 for the stock? That's
Cost basis.
Right on, right? Cost basis is simply when I turn the money in the investment. And let's say that I sell the stock later on down the road, I turn the investment back into money. And let's say I made, I sold it for 21. So I made $1 in income stream and I made $1 in price appreciation. And so they asked me, what is my total return? What I simply do is I take both that, the $1 I made from the income stream, plus the $1 I made in price appreciation. So I made a total return of $2. And it cost me to make that $2. I invested $20. And so test question, what is my total return? I simply take what I made divided by what it cost me. And you would tell me on the test that the total return here is 10%. So you take the income stream plus or minus the price appreciation. What I mean, it could be negative, right? So for example, Eric, if I bought this for 20 and I sold it for 20, the total return would have been 5%, not 10%. That is a calculation that I think you're going to have to do or could do. It's low probability, but it's testable. So in terms of Erica's questions, the only math she's going to have to perform is this, potentially this, and current yield as well. Okay, so let's see. That's IRR, CAPM, Sharpe ratio, total return. Okay, so let's see what's next on our list. Are those QIDs, Cynthia? Are those just in the standard Kaplan Q Bank, or are those midterms or finals?
Those are from the simulated exams.
Okay, let me bring that up, see if I can bring that up. By the way, if I sound a little short, it's because I just had a major water leak and I had to go out and literally 5 minutes ago and shut off the water to my house. So I was in the live stream and somebody kept ringing the doorbell. I said, I'm going to be so mad if after this live stream, it's, you know, somebody's door to door trying to sell me something. And it was my neighbor. And she goes, you realize you got a lot of water running on the street? I go, oh my God, no. So got a major plumbing problem. We'll see what happens. Maybe I'll just move to my off the grid place, Eric. I'll just say goodbye to the big city and off I go. Let's see.
Don't you dare, Dean.
Let's see. I'm trying to get out of the full screen so I can go find my Kaplan Q Bank. Here we go. Okay, here we go. CAPM QBank. Let's bring that up. And Cynthia, it's a Series 7 QBank you're using?
Yes, Series 7.
Okay. It's loading. I'm very empathetic with you guys as test takers when you're trying to load your QBank and, it takes a while, or sometimes they tell you it's unavailable, or, I'm an old fashioned guy. Sometimes it's good to have old fashioned print material. Loading, loading, loading. All right, so let's see. Let's grab the 7 QBank. Excuse me. And let's now go find you guys again. Where'd you guys go? There you are. All right, can you see the CAPM QBank? Yes,
Yes.
no? Okay, so Cynthia, can you give me that QID again? I'll put it in here. What was the QID, Cynthia?
Yep, it's let's see, 131
Uh-huh.
2770.
1312770.
Yes.
All right, let's do this. A real estate limited partnership is created for 800,000. Are you here, Wendy? So Wendy, as I told, yeah, test prep vendors go way over on partnerships for tomorrow. This is way, way north of what you're going to have to do. But anyways, this is a limited partnership, so we raised $800,000. We should definitely know the difference between general partners and limited partners. The general partner, I'll be the general partner. We've got 8 people in this virtual classroom, so we all put up 100,000, the 8 of us, to go buy whatever. Let's call it an apartment. Oh, well, we got an office building, so we're going to go buy an office building together. Each of the limited partners has a 10% equal share. The proceeds are used to purchase an office building for 2. So that looks like to me, from so far, we should have been able to determine that there's a mortgage of $1.2 million. How did Dean determine there's $1.2 million on the mortgage? The way I did that was to take the 800,000 that we had in equity, and we bought an office building for 2 million. So where'd the other $1.2 million come from? It came from a financing. So the additional finances are provided by a non-recourse. That's key. So non-recourse means what we're hoping is the partnership will be able to pay back the borrowed funds. But non-recourse means the bank cannot come after the partners for this investment, of the non-recourse bank loan. The exception would be if this is a mortgage. Economics conditions cause the occupancy rate to fall dramatically, and the partnership is dissolved as insolvent. Each partner may claim a loss. Now, your loss is going to be for what you put up. And so, you had 10% of $2 million. Remember, that was our total investment. So your piece of that is $200,000. Cynthia, did you say 80,000? That would have been the good miss here.
I did actually, yes.
Okay, so that you did, that means you didn't recognize this as a mortgage, which does add to the cost base. Let's see what our friends at Kaplan tell us. Losses may only be claimed to the extent of your tax basis. The 800,000 was divided 10 ways, 80,000. The financing $1.2 million, so that's the mortgage on the building, right? Mortgages are non-recourse borrowing. Non-recourse adds a basis only in real estate. There you go. There you go. So 2 million. That was a tough one. Tough one. Now, if that would have said recourse note, it would have been 200 as well. Like if it was a hedge fund or something like that. All right, what's your next one?
All right, the next one I have, this one stumped me, at least as far as how it was worded, but it's 126
126
5481.
5481. Which of the following? Oh, this is very testable. Anybody want to help Cynthia out with our memory aid device? Worth lots of points. What is that memory aid device? Slobs over.
Bloss.
We interpret, we know
Bliss.
but
Bliss
we don't
or
take
bloss.
the
Same
time,
thing.
And aren't
Somebody's got their watching the game or something. Now, I wouldn't want my order triggered, Cynthia, as a result of the ex-dividend date, right? Because remember, the stock is going down by the ex-dividend on the ex-dividend date. And I don't want my order to be triggered. And so I'm not going to have a problem with an accidental trigger based on the ex-dividend for any order that is above the market. The only way the market could be triggered, the order that could accidentally be triggered of the X date is an order below the market. And so what this is actually asking you is which of the orders you're looking at is below the market, because we only adjust orders below the market. So now we can apply our memory aid device bliss and say, okay, buy stop is above the market, and we don't adjust orders above the market because there's no way they would get triggered. Sell limits are above the market, buy stops where they become market or limit, leaving us with the answer, which is a buy limit. That is testable. That is testable. Does that take care of that one for you?
Yes, that's good. I think I got tripped over just the wording of like the ex-dividend date and trying to think a little bit too much on that.
Well, Kaplan there jerks in a good way. So Kaplan's trying to stretch your mind and hope it doesn't go back to the same spot. All right, any more Kaplan QIDs? I think that was the last of our Kaplan QIDs because I don't want to put away the Q bank if you have more Kaplan QIDs. Let me check chat.
Would the Slav and Bliss be the same for like the Series 66? Would that work as
Absolutely, absolutely. But the 66, we kind of sometimes assume, not good, makes an ass of you and me, that's fresh. And so, we're assuming that if you just took your 7, that you don't need to review as much of orders. But yeah, orders is fair game on that as well. All right, so we took care of the QIDs. Kaplan, here's another QID from Trish. Is this Series 7, Trish, this Kaplan QID?
Yes.
Okay, perfect. So let's put that one in here. This is 1265385. 126. I'm sorry, clean up my mess here in just a minute on the slide. 5385. Let's clean up my slide. Client, by the way, Erica, we can do the same thing on your 66. So, did you get your Kaplan Q Bank as a paid supplement to your Past Perfect?
I did, but I haven't got to the finals yet. I'm still
Okay,
working
but same
through
thing,
Past
same
Perfect.
thing, right? So sometimes, particularly on those things like Sharpe ratio and capital assets, sometimes it's better to actually have a particular question we can look at and discuss. So just, start making your Dean kind of QID to-do list kind of thing like you did last time. A
Okay,
client is a
sounds good.
manager of a large pension plan. If you're not participating, hit the mute. Client is a manager of a large pension plan, has recently changed the plan's portfolio, weighting from 80% equities and 20% bonds to 40% equities. Ooh. So it looks like I'm, selling some of my stocks. And then I'm buying short-term treasury debt. Man, that sounds like a really nervous if I'll just make up a number. I had $100 million portfolio. I had $80 million in stocks and 20 million in bonds. And I'm taking the portfolio down to 40 million in stocks, 40 million in T-bills, and 20 million in cash. That sounds like to me a bear. What were you struggling on this one, Trish?
I missed the word "to." I thought it was.
There you go. So,
yeah.
by the way, Kaplan, the guy Kaplan, who's our subject matter expert on this stuff, is a guy named Chuck. And him and I go round and round. This happens a lot, Trish, where somebody misses it because of the wording of the question. And I give Chuck a hard time saying, listen, the person, they didn't answer it because they can't figure out what the heck you're asking them because of the poor grammar and the poor wording. But, he's purposely trying to match the poor wording and grammar of the test. So I guess good news, Kaplan's trying to stretch your mind and hope it doesn't go back to the same spot. Sometimes that doesn't happen. So Chuck has some questions on Kaplan say, gotcha. I call them gotcha questions like, well, this might not be, well, why this won't be on your exam? I'm like, well, then why are you giving me a practice question on it, tough one. Any more Kaplan QIDs? Let's see, we got any more Kaplan QIDs? Cynthia, 147. Is that, let's put that one in there. Oh boy, did I forget to record our session? No, okay, I did. And I said, we do all this work and I forgot to. 1476229. An investor purchased 200 shares of High Time National Bank at 120.06. And I'm sure Erica can tell us that's our cost basis. So that's simply when we turn the money into the investment. Very important, 13 months later. So I've had this, been at risk for more than 12 months. So that's important that I've been at risk for more than 12 months, because if I'm at risk for more than 12 months, any gain is going to be long-term. There's no change in your proportion ownership when there's a stock dividend. So my cost basis is the same. It's just now I'm going to have more shares at a lower price. So there's a couple ways to proceed here. I think the shortcut I would have done, and I'm always looking for a shortcut, is I would have taken 200 shares, let's see, times 120.06. And what I'm doing here is just figuring out my cost base. My cost base is $24,012, excuse me. I'm terrible at arithmetic, so I'm using my calculator because I'm terrible at arithmetic. And I'm just going to do it one more time just to make sure I punch the right numbers on my calculator. I'm showing 24,012 as my cost basis. Okay, so now I have a 15% stock dividend. So now I'm going to take my 200 shares times 15%, and that means I'm going to get 30 additional shares. So now I have 230 shares. So the way I got the 230 shares, I took my calculator, I took 200 times 15%. I get 15%, so does everybody else. And now it says I sold. So now I'm going to sell my 230 shares at 112.57. And that gives me $25,891.10. And then I'm going to just subtract those two numbers and hope that I come up with one of those choices. And so let's see, 25,891 minus 2412. And it looks like I did some math here. 3 months. Oh, 3 months after that. Oh, look at this, RTFQ. 3 months after that, I sell the shares I received from the stock dividend. So now I have to go back and do my adjusted cost base per share. What a Cynthia, man, boy, Kaplan, what jerks. Okay, so now I go back to 24,012, and I'm going to divide that by my 230 shares. I get a cost base per share of 104.40. Right, so that's my cost base. How did I do that? I took, just reviewing, I took 200 shares times 120.06, and I got my cost base of 24,012. I then figured out how many shares I got additional. I took 200 shares times 15%, and I got 30 shares more. So now I have 230 shares. And for that, I paid 24,000. So my cost base is 104.40. And now I sell 30 shares for 112.57. So now I'm going to take 104 and compare that to 112.57 times 30, and I get my answer of a wow. That was a tough one. By the way, that's a sign too, Cynthia. When Kaplan has to spend that big a paragraph telling you the answer, that's a chance that it's not so good. So let's just see if I did what Kaplan did. 24. Okay, so far they did what I did. Okay, yeah, I think they did pretty much what I did. Any question on that one, Cynthia? I think that's outrageous.
Actually, no, that was a toughie. I got it down to a 50-50 with the long term, but after that, I was a goner.
Yeah, I'll tell you what, that's I think you definitely need to know long-term capital gains for more than 12 months. I think you definitely need to know there's no tax consequence to receiving a stock dividend. And that's pretty much it. All right, any more Kaplans? Let's see, we got any more Kaplan QIDs? No, that looks like it. It looks like Wendy has a margin account, so let's get a whiteboard. Let's clear up our last one. Clear. Let me put the chat where I can see it. Okay, so we have a short market value of $9,000 credit. So you got to know the classical margin equation. So we're going to take 13,000. which is our credit register. That's where most people get hung up. That's the cash we got from selling the stock we don't own, plus the half we had to put with it. And the classical margin equation, which I told you is important to know the classical margin equation. The classical margin equation is short, is credit register minus short market value equals equity. And so it tells us that the short market value is 9,000. So now we're going to minus the $9,000. That represents what you owe, and what you owe are securities. So it's the same on long and short. The second ledger line represents what you owe, and you owe $9,000 worth of securities. Now, we said the most important thing to know is the classical margin equation, long and short. And so boom. And so now we have $4,000 in equity. And boom. Okay. Now, by the way, I would do this. I haven't looked at the question yet, because as I've said, what we want to be able to do is the setup. So as I'm going through the question, I'm doing what's called the setup. And then typically what we're going to have to do is a mark to market. Then it says a maintenance call. So you should definitely know market value at maintenance. They're not asking what is maintenance. Maintenance is 30%. They're saying how far down could the account go before you would be at maintenance? And the formula for that is the credit register divided by 1.3. And so in our example, the credit register is $13,000. And we would divide that by 1.3. And that would give us the answer. Where is my calculator? There it is.
10,000.
Thank you, 10,000. So that would have been the answer to that one. Wendy, I'm worried about you still being here on the live when you're testing tomorrow. And this is not going to be something you're going to have to do. You should definitely know 30%. And maybe that's what you tried to do, Wendy. That wasn't the question, but maintenance would have been 30% of 9, but you don't have a problem right now. So 9, I'm just going to times that, is 27, and you got 2,700, Wendy, and you got 4. So you got no problem right now. All right, let's see what our next one is. Mutual funds, lots, Rachel, lots. You're going to get those packaged products. That's 20 questions plus on mutual funds, variable annuities, ETFs, all that kind of stuff. So you're going to get lots of them. Yeah, I'm just waiting, Erica, to see your point. I didn't see any water damage, so good news. It's just on the corner of the house. And so once I turn on the water, I want to see if it was on the outside of the corner of the house or the inside. And so it's on the outside. I live in a place called Desert Shores in Las Vegas, and it's a subdivision. And we all know that whoever the developer was did not do a good job on the plumbing. Everybody's got all kinds of plumbing problems. Yeah, I got to figure out, Erica, where I'm going to try next time I go. I'm going to take my T-Mobile. They have a home internet thing. I'm taking that. If that doesn't work, I'm going to have to buy a Starlink. Over EPS versus price to book. You won't see price to book, but you're certainly, Benito, going to see PE. And so, you know, if we have a stock and, for example, we say the earnings per share is $5, and we say that the stock is priced at 50, price to earnings. So if you can't decide what to do, you're always going to divide price over earnings. And so here it would be 10 to 1. The PE ratio. It takes you back 10 years to get back in price what you paid, or in earnings what you paid for price. Ratio always means division. Always means division. So, you know, you need to do the PE, by the way, you need the earnings per share. That's typically given, particularly on the 7. I don't think I'm going to make you work for that. And then remember, the board will decide how much of the earnings, if any, to declare as a dividend. So the board would meet and say, we have $5 in earnings per share. Do we want to keep that as retained earnings, or do we want to distribute some of that as our shareholder, do a distribution of dividend? And then maybe they ask you about dividend payout ratio. So for example, Benito, if we pay a $2.50 dividend and we had $5 in earnings per share, our dividend payout ratio would be 50%. And we would expect a dividend would be associated with a mature, stable business. Right? You said you're taking the 7. You're taking the 7, Benito?
No, I'm actually taking the 66.
Okay, 66.
Yeah.
Maybe, Benito, maybe. They might give you net income and shares outstanding. You might have to divide to get the earnings per share. I haven't anybody been able to tell me they had to do price to book value. If they ask about book value, they're asking the theoretical liquidation value of the business. So this is an answer set, Benito, you definitely will see on perhaps on all the exams. You might see this answer set.
Yeah, because this is my second time taking the 66.
Oh, there you go. Yeah, so we gotta find that for you.
And
So
I did
here
it
is
before.
here is definitely an answer set. You know, if they say, let me clean up some of this stuff. If they say which of the following is an arbitrary number used to set up the books? I know it wasn't let me do that. You would say par value for common stock, that would be $1, Benito. For preferred stocks, very testable 100, and for bonds, very testable 1,000. And if they ask you the theoretical liquidation value of the business, that would be book value. Now, your point about price to book, fundamental investors like to have what they call a margin of safety. And if I can buy the stock, let's say book value is 50 and I can get it for 50, 1-to-1, that would be awesome because that means the liquidation value of the business is worth what I'm paying for it. So again, price to book is a ratio. You're just getting price divided by the book. And again, the lower that ratio, the more margin of safety for a fundamental investor. Don't think they'll ask you to do anything other than understand that represents the theoretical liquidation value, because we don't assume we're going to liquidate unless we go bankrupt or something. And then market value would be supply and demand relationship. Erica, if you get margin on 66, it would just be the documentation. It would be very, very basic. Slobs over bliss, Wendy, is worth some points tomorrow. So I don't know if you're going to do a data dump sheet, but if you are, I would certainly have slobs and bliss on it. Oh, well, that's cool. My dad, the missionary, would be very happy with that. Another, Wendy, is that a QID? Let's do Benito's 66 QID, and then we'll do Wendy's QID. I think I put away the Kaplan Q Bank. Oh, was that the Kaplan Q Bank? I still got it? Oh, hoo-hoo. I'm technically literate. I'm going to do her series 7 one first because I still have that Q Bank open. So I'm going to do that one first, and then I'll do yours. 131. 131. I'd be interested too. We're pretty agnostic about study materials, and I don't want to come off as too much of a promoter or huckster kind of guy. But I can just be so much helpful if people get a Kaplan Q Bank, and I'm not quite sure if I just like on the Reddits and the YouTube channel say, I could be a lot more helpful if you had a Kaplan Q Bank. So I don't get any commission. That's not coming up, so that probably, Wendy, means it's like a midterm or something like that. What was it? Do you have it handy?
Yeah, I can read it out.
Okay, well, let's do Benito's first. Let's clean up. Let's do Benito's 66, and then we'll come circle back on that one. I like that name, Bonito. Very famous Mexican patriot was Benito Juarez. I think he actually got tossed out during the revolution, I think. But
that's him.
Yeah, they have a big. I go to Ensenada. They got a big plaza where they have all the.
Oh, nice.
Yeah, it's like a giant head. It's like
the monumental.
What's that?
Like the big monumental type.
Yeah. It's crazy. He's there, and I think the Diaz is there. I forget who all was there.
Yeah.
Let's see, 66.
I feel like
this is what Erica's taking too. Erica's taking her 66 as well. Okay, so yours is 118. Well, come on. 118. 0390. That too must be 118 0390. But this must be a midterm or final, because they don't have let me have access to the midterms or finals, because they don't want me telling you what the right answer is on that. All right, so let's circle back, Cynthia. I would create your custom quizzes. So when I was talking about in the live stream tonight, so you can do simulated exams, custom quizzes, and you pick out what you want to. Somebody asks like mutual funds, you click whatever you want to do. You can create your own thing, and it gives you a performance tracker telling you what your weekend. So that's how I would use that. Okay, it looks like we didn't bring up that. So Cynthia, what was your series 7 question? What was that 1310452 about, Wendy?
An hour ago, you entered a sell limit order for your customer in XYZ stock. Looking at the current quote, you could expect the order to have been executed if.
What was was the sell limit?
It didn't give a number.
Oh, well, that price or better. So if it's a sell limit, it's that price or higher. If it's a buy limit, that price or lower. Is that one of your choices?
So choice A, the bid price for XYZ is higher than your customer's sell
Yeah, because
limit.
remember, so now they're adding more complications to it, but as a seller, you're going to be, as a seller, you get the bid. So the bid would have to be higher, the same or higher. As a buyer, you pay the ask, right? So that's what they're getting at. So read the question to me again one more time.
An hour ago, you entered a sell limit order for your customer in XYZ stock. Looking at the current quote, you could expect the order to have been executed if. And again, choice A is the bid price for XYZ is higher than your
That's the
customer's
yes.
sell limit.
Yep.
And
Say.
Okay.
Say.
Well,
All
there's
right.
two that say higher, and then there's
Oh,
the
really?
second
What's the other one say
two.
that's higher? Bid?
Okay. So choice A, the bid price for XYZ is higher than your customer's sell limit, and the last reported price in the stock is below the sell limit price.
Oh my God. Yeah.
Choice B, the bid price for XYZ is higher than your customer's sell limit, and the last reported price in the stock is above the sell limit price.
Yeah, I think what they're getting at is the bid might have been moved based on whatever you're reporting. What did they tell you the answer? Did they tell you the answer?
No, I haven't finished it yet.
Yeah. Oh, what do? You still working on those last 20? I'm worried about you. I know you're not testing till about noon, but
Well, I FaceTime my kids before they went to
okay.
bed.
All right. I like on those answers, I like A, but I think they might give us some trick about the reported trade might have changed the bid on that. So to be determined. Let me know. Send me an email. Let me know what they told you the answer was. But I would have gone for A, I think, what I've gone for.
Yeah, I went for A, but that one tripped me up a bit.
Yeah, that's a tough one. All right. So Benito, what was yours on the 66?
So it was basically more of a buy limit, buy stop, sell limit. There was a couple questions. Can you do like just a quick
Sure. So the one that comes up a lot on 65 and 66 is about risk mitigation. And so risk mitigation is about having a stock position, right? So I would either have a long stock position or a short stock position. And so the one that shows up on 65, 66 is what order you would use for risk mitigation. And you should know that the number one use of a stop order, is the stop a loss. And so you would place to protect our risk mitigation on long stock, you would put a sell stop to stop the loss. And it's very testable to know, again, that you'd place that below the market. So Benito, if we buy 100 shares of Apple today at 170, maybe we put a sell stop at 168, for example, and stop the loss at typically 2 points. You know, it's a weed puller. And then what would we do to protect a short stock position? We would put a buy stop, and that would be above. Right. That's it. That's about it on 65, 66. I would suggest to you, however, there also is risk mitigation not involving orders, but options, right? So you can use order to do it, risk mitigation, but you could also use an option for risk mitigation. So, and again, this is testable on 65, 66.
the one for like protecting the long.
Hey, Mom, what's up? Hold on just a minute. I got you. I didn't tell Mom about the leak. I think I'll wait till she gets home. Right? So at least she's not going to pull up to a major flood. So, all right. We can also use options for this. So what would be, this is testable for everybody, 7, 65, 66, even SIE to a certain extent. I mean, it'd be a tough SIE draw. What option would we do for risk mitigation on a long stock position?
buy a put.
Right on, right on. In fact, we call that a protective put. Right, and what option strategy would use for risk mitigation on a short stock position?
We buy a call.
Right on. So those go together. Now, on the Benito, as you know, on the 65, 66, there are multiples. I was telling Wendy tomorrow she won't get a multiple on thinner exams, but you can get that on NASA. So what I'm saying is I could ask you, Benito, like I could make this Roman numeral 1 and make this Roman numeral 3. And I could make this Roman numeral 2 and make this one Roman numeral 4. And then ask you that question as a multiple and say, you know, which two of the following would be risk mitigation on a long stock position? And you'd say 1 and 3. And if I say what would be risk mitigation on a short stock, you'd say 2 and 4. So we could do that as well to you. All right. Anything else here before we call it
Have you experienced any HSA questions on the 66?
yeah, you'll get an HSA. You could get an HSA question on 65, 66. If you do, it's a one question. It's about it's only good for qualified health expenses. You can't use it for like plastic surgery, for example, unless it's, you know, reconstructive surgery because of an accident or something. So yeah, you could get a question on that, Benito.
Thank you.
Anything else? What do you think? Should we put another live stream overtime session for next Tuesday as well or not? Yes or no in the chat? Should I put another one up or should we take next Tuesday off and do it following Tuesday?
I'd say yes. My exam's next Wednesday.
Okay, so yeah, I'll put it up. You can register first come, first serve. It's capped at 10. And so, you know, make sure you go there right away because we don't, you know, we can't get anything done if there's like a live stream. We had like 40 people in the live stream. So, you know, it's almost impossible to do this in a live stream. Somebody asked, is the option class? I think there's still a spot. You can just go there and register. If there's a spot, it will let you register. If there's no spot, it'll say there's no, it won't show up as a class. If you have a problem and you still want to do it, I'll let you in and you can send me a email. Let me just put this to everybody here. Should let you register. I think there's a spot left, but let me just put in my email. I'll just put it on the screen for you. So if you're trying to register for that, now remember the deal on that. I think it's a pretty good deal, but you know, of course, I think it's a pretty good deal. It's $35, and if you miss it, it's okay because it will show up as a replay. But what you get for the $35 is not only the course, you also get free office hours. I know there's one spot left on the office hour. So if you buy a paid class from me, I will give you free office hours. That's capped at 5 people. Once it reaches a cap, then I open up another office hour. So you get that, and then you get a free repeat on when I do the class again, you get a free repeat on that. The live streams are completely free, so you don't have to buy anything. And then I'm gonna do the next week, next Thursday, stock plus options, $35. And then if you buy those two for $70, then you get the advanced options for free. And that's $60 for that. So that's kind of how that works. That's not a cap. I teach for CAPM public classes. This is just me doing an evening class. I think Cynthia's been attended some of them. And I know Erica has. And I say an hour, but you know, we go as long as it takes to get through whatever it is that we are talking about. So I don't think I finished yet on the hour. I'm hoping to get better. I'm now, if it's not an hour, I call it 90 minutes, but you know, it is whatever it is. All right. Anything else? Okay, I'll put up the as soon as mom gets here and I go through the drama of the water leak, either late this evening or tomorrow morning, I will put up the Tuesday live stream for next week. Any other things here? Okay, I think we covered everybody. Did we cover everybody? You can unmute. If I didn't cover your question, just unmute yourself and you can ask me the question before we call it a night.
Thanks, Dean.
You're welcome. My pleasure. My pleasure. Okay, everybody, I will see you next Tuesday. Remember, inch by inch, your Series 7, 66, whatever you're taking as a cinch, yard by yard is hard. And I'll see you Tuesday, 5 p.m. for the live stream and overtime maybe, or even sooner. Who knows? Talk to you later. Bye-bye.
Thanks, sir.